Inflation is a game. We play with ourselves and we always lose it. In the fiat money environment, for the system to work long term, money has to keep the value it had when you earned it and when you saved it. If that value declines, then we end up in a world of hard-to-notice theft. Savers are robbed, asset owners are rewarded more than their first share, banks lose the trust of their customers and vice versa, Treasuries finance their deficits by kicking the can down the road, by borrowing more than either cutting spending or raising taxes, and eventually by borrowing in order to increase government spending still further. And inflation is not just an economic problem for finance ministers to solve. It's a moral problem for ordinary citizens as well. It impoverishes the poor, the old, and those on fixed incomes with particular severity. But it enriches the better off who have assets that rise in value as prices rise. It encourages companies to hike prices covertly by cutting the number of potato chips in a bag or the amount of beer in a glass. And it's for workers to win higher wages through collective bargaining. Inflation reduces their take-home pay while they're still walking home. And if they strike for still more money next year to recoup their losses from inflation, that will only add another twist to the inflationary spiral. The 1980s generation of politicians who took on runaway inflation of those years often did so clothed in the language of morality, and they were right to do so. After all, tackling inflation requires us to make sacrifice at the heart of morality. It's short-term pain for long-term gain. But why do we never learn our lessons when we've solved that problem? That inflation is a mug's game. Restoring price stability is hard and means a loss of income, jobs and growth. Brian Griffiths was Dean of the City of London University in business school before he became director of number 10 policy unit in Downing Street. He later served as vice president of Goldman Sachs. He chaired the Griffiths Commission on Personal Debt in 2004. And for his services, he was created Baron Griffiths of Foresthack in the House of Lords. He is also a committed Christian. It is with all of these priors in mind that he came to his latest book entitled Inflation is About More Than Money: Economics, Politics and the Social Fabric. Today, Brian will be joined in discussion by Philip Pilkington. Philip is a Danube Institute Fellow and the author of his own new book, The Collapse of Global Liberalism and the Emergence of the Post-Liberal World Order. Philip is also a professional economist and a somewhat unorthodox one. Both of them see economics through a moral lens, and both of them believe our institutions should be more than just scorekeepers. Today, we'll be discussing their perspectives on the proper relationship between inflation and morality. Brian, many thanks for coming on the program. You have written this book about inflation in all of its aspects, and I want to begin by asking you a very simple Simon question. What is inflation? Because it's not just rising prices, is it?
No, it's not. Inflation is a process where prices are rising year after year. The general price level is rising year after year. And we've seen examples in the 1970s throughout the Western world, and we saw examples during COVID throughout the Western world of prices rising over so many years, year after year. And you should distinguish that from a relative price rise. So there may be a one-off increase in the overall price level, but that's because one price relative to another has changed. Its weighting in the price index is such that it will lead to an increase in the price level. But after you've had the one-off increase, and you see, for example, a one-off increase at present with Mr. Trump's tariffs. Because of the tariffs being increased, we're seeing a one-off increase. But that is not a cause of continuous inflation. Unless the Federal Reserve, the Bank of England, the European Central Bank were to increase the money supply at present, we will not see continuous inflation from this. It's much more a one-off thing.
Now, all through my lifetime, there seem to have been people quarrelling, disagreeing, I should say, about the causes of inflation. Some people arguing that it was caused by pressure from below, demands for more money, the shops increasing their prices, corporations increasing their prices, greedflation, and the opposite explanation, your own, I think, namely monetarism. You describe yourself as a pragmatic monetarist in the book. Could you just briefly explain what that means and why you prefer that explanation?
Well, the reason I describe myself as a pragmatic monetarist, and I should add, by the way, that Hayek said he believed in the quantity theory of money, but he didn't believe in Milton Friedman's version of it, because Milton Friedman's version suggested you could calculate with some precision what the exact increase in the money supply would lead to. And the reason I think I would describe myself as a pragmatic monetarist in the Hayekian sense is that I know of no inflation which has been sustained without an increase in the quantity of money. So then the real question arises is, why do central banks create money? Or why in a previous century, if gold came in, for example, to the UK because of exports or whatever, how did that process work? And I think that there's a real connection there between money and inflation. But the question you have to ask is, particularly in the 20th century, why did governments create money? And what you find out is that they've created money typically because there were no more taxes that they could increase to finance their expenditure. And in a way, creating money was a last resort. I don't think any government ever set out and said, in our program, we're going to create inflation or hyperinflation. Germany didn't do that. Hungary didn't do it. Hungary had one of the worst inflations ever recorded at the end of the Second World War. But I'm sure the government at the time didn't set out and say, we're going to create inflation. They said we're going to have price stability. They found it difficult. Expenditure ran away with them, and so you have inflation. So I think asking that question, why would we have inflation, or why would governments create money too, which results in inflation, is a very important question to ask. And I think the question at present is, central banks are really wanting to bring down interest rates. I mean, Trump berates the head of the Federal Reserve because he says you should have lower interest rates. But economists know that if interest rates come down too fast, money supply will start growing, inflation will start rising.
Thank you. Well, let me just now assume that everybody agrees that having price stability is a good thing and inflation is a bad thing. We really, therefore, need to move on to the question of what policies we can pursue to prevent a recurrence of inflation in the post-COVID world. I'm going to bring in Philip Pilkington here, who shares with you not only economic expertise as a professional historian, but also a Christian belief in Christian responsibility in public life. So, Philip, could I just begin by asking you to give a general response to Brian's points and to the book.
Well, I think I kind of come from, I guess, a different generation of economists and understanding of how money supply impacts inflation. I think there's probably two ways that are kind of interrelated to understand why this is. I mean, we could go really deeply into the theory, but I don't think that's necessary, really. I think basically what happened was my generation came of age after the 2008 crisis, financial crisis. And in the wake of the 2008 financial crisis, central banks did actually try and generate inflation. So there has actually been a period, and it happened in the 1930s too, when in a period of soft price increases and some deflation, the central bank decided to try and raise the rate of inflation. And it did so through quantitative easing programs. Now, quantitative easing programs were monetarist programs. You can go and read Ben Bernanke's original statements on them, his original papers on them, and so on. He says, we learned what caused the Great Depression from Milton Friedman, and we're not going to make that mistake again. That's effectively what he said. I think he was more so concerned with saving the banking system when he stated that. But there clearly which, by the way, quantitative easing probably did. But there was a belief, there was clearly a belief that pumping money into the system via quantitative easing would raise the price level because they kept doing it. There was multiple rounds of quantitative easing, and the explicit goal was to get inflation to rise. It didn't rise. It didn't rise at all. And so I think my generation was very suspicious of this argument because we watched it in real time being tried for 12 years or 13 or 14 years. Quantitative easing was very good at pumping up asset values. Asset market values are very obviously tied to quantitative easing. I did a paper on that when I worked in investment management in the City of London a few years ago, or it was quite a long time ago, 8 years ago or something like that. And we could show this. It was extremely obvious. It was well known in markets and so on and so forth. But that was effectively the problem, that we saw that the central bank came out with an explicitly monetarist policy to try and create inflation, and it didn't work. And basically, I won't again go deeply into the theory, but when you're looking at it statistically, it's quite simple to describe what happened there. We can look at the US, and what we see is that the velocity of money fell dramatically. So the old monetarist equation is the money supply times the velocity of money equals the price level times the quantity, which is usually thought of as output, I suppose, in the economy. And what we saw is that M went up. M went up because bank money was created at the central bank, but V fell. So it started at about 2, I think. The velocity of money was about 2 in 2007. It fell to about 1.5 after the QE programs. And then after the pandemic, it fell again. I think it fell down to nearly 1.1. Now, that's not a 10% or a 20% decline in the velocity of money. That's a halving of the velocity of money. So what that means is you can have twice the money supply in existence with the same price level as previously. So implicit in the Friedmanite quantitative money theory, I think, was a basically stable velocity of money. And I don't think they'd have claimed that it had to be completely stable, but I think they'd say that the fluctuations within it had to mean revert, if you want to use the statistical terminology, and the fluctuations probably couldn't be enormous, maybe plus 10, 15%, minus 10, 15%. So I think this is effectively why the quantitative money became kind of unpopular with economists of my generation after 2008. And I think just the final point I'd make on that is I think that's why in the recent inflation, we've seen bad inflation now since 2020, and there hasn't been that much discussion of this if in a quantity of money framework, which is kind of unusual because you'd expect in a serious inflation that that economists would dust off old theories of inflation and compare them to each other. That didn't really happen in this inflation, and I think the reason for it was what was widely seen as the failure of the QE programs to create inflation.
Brian, would you like to come back? I have a story about Friedman on that, but come in if you would.
Yeah, I think it's. I mean, I was at Goldman Sachs during the years that Philip mentions. I don't think the governments actually were really wanting to raise the rate of inflation. They wanted to raise the price level because they thought that, we faced such a potential loss of confidence, a downturn, and so on, that they needed to get the economy moving. And hence we went into negative interest rates and all of that. But if you look at, say, the COVID period, and you look, I mean, I'm really only familiar, well, I'm familiar most of all with the UK. But if you look at money supply growth, COVID started in the spring of 2020. During the rest of 2020, but particularly during 21, and not until really the beginning of 22 did you see actually, the money supply increased enormously. And with a time lag of roughly 9, 12 months, what happened was that the price level increased as well. And in the UK, if you look at Tim Congdon's work, I think it would be wrong to say that there was no relation there between money supply growth and the price level. And in addition to that, if you look at the work of people like Alan Walters, who I worked with at the LSE, and what a colleague of mine, Warburton, found, who's an econometrician, is that there is actually a fairly stable long-run demand for money in the UK, but there is not a stable short-run stability in the demand for money. So it's very hard to tell the central bank, this is what we know exactly what you should do in fixing the level of interest rates or interfering with the exchange rate if you want to change monetary conditions. But that is not the same as saying there is not a stable demand for money.
Can I just tell the story? I went to Milton Friedman actually at a conference and said, Milton, and I can't give the date on this, but I can't remember last whether it was before or after the crash, but I said to him, look, there's been a significant increase in the money supply, but no increase in the rate of inflation. How do you explain that? And he said, well, John, have you looked at the rise in asset prices, which, Philip, you did mention? And he said, what's happened is this. The rise in the money supply has coincided with a dramatic increase in free trade, and with America particularly receiving strong competition from imports, particularly from Asia, which has held down the general price level, and the excess money has gone into asset prices, which at the time were dramatic. The rise was a dramatic one. Does that in any way impact on what either of you have said, Philip?
Well, I do think definitely the QE programs did result in an increase in asset prices, but the issue there is effectively, I was working in asset management at the time. Everything's benchmarked off interest rates, so when you drive down an interest rate very, very low, you have a rush for yield. It's called reach for yield. It used to be called in the market. So if you're a capacity to get interest rate on a safe government bond, the 10-year gilt or something like that in the UK, or 10-year Treasury in the US, if you can't get enough investment income from the yield on that bond because it's too low, you'll obviously go and invest in equities, and you'll take a much higher multiple, a much higher price to earnings ratio, so a lower future return in theory, or you'll plow your money into property or something like that. But this is not technically inflation because it's not in the CPI. Now it can feed into the CPI. So, for example, if house prices go up due to rising asset values, owner's equivalent rent, which is counted in the CPI, will go up. But that's kind of a second order effect. So I would agree with Milton Friedman if that was his analysis. I think that's kind of what happened. Maybe I wouldn't fully agree on the mechanisms that held down the actual CPI, but I think he's describing a phenomenon that happened. But the prices that were rising are not counted in CPI. Now, you could make the case maybe that housing should be counted in CPI. Maybe, I'm not sure. Very difficult to make a case that equities should be counted in CPI. I don't think that would make a great deal of sense. So no, I really firmly believe that central bank monetary policy in general, not just in terms of quantity of money, but also also interest rates mainly impact asset prices. I think their impact on the economy is actually a lot weaker than economists thought, and I think that's kind of what we learned in the wake of 2008.
Do you have any further comment, Brian, on this?
Well, I think I would say if you have an increase in the stock of money for whatever reason, then whoever's holding that money has the option of putting it into some very liquid asset or putting it into some other financial asset, or ultimately buying consumer goods or buying investment goods. There's a whole spectrum there. And I think that central banks were bringing down interest rates, allowing money to increase. Real interest rates were negative. And, immediately they were switching into a variety of assets and so on. So, as Philip says, the velocity of money was changing. But ultimately, I think that worked itself out. And you built up a stock which really comes out, I think, very clearly with after COVID, in the COVID period and so on.
Now, I'd like to turn to a slightly different question, which is the response. What job does the central, or do the central banks, plural, have? Brian, you argue that the essential job they have to do is to sustain price stability, and the other objectives, whether they are, for example, increasing employment and growth, or secondly, particularly obligations placed on them, for example, to direct more investment into climate-friendly investments. These are, in your view, very secondary. Indeed, they're not the aim of the central bank at all. Is that a fair view of your argument?
Yes, I think the primary objective of a central bank is to control the price level and to also aim at financial stability. If you control the price level, financial stability is much easier to achieve. I think, the Federal Reserve in America is meant to focus on controlling the price level, but also on the level of employment. I think there is no long-term trade-off. And I fear at present that the major central banks in the world are being tempted to try and deal with the labor market through monetary policy rather than focus on the one thing monetary policy can do, which is to affect the price level. That's one problem. I think the second problem, which certainly on the Select Committee on Economic Affairs I've been on in the House of Lords in the last 3 years, and we've examined this in relation to particularly the Bank of England, is that the Bank of England has been given so many other things it should do, in particular things like climate change and so on, DEI, all sorts of things, which in the end take it away from its primary objective. And the key executives in the central bank, the governor saying that I think half dozen or so deputy governors, their time is limited. And if you ask them to get involved into all these other issues, I think you are overloading what the central bank can really do.
Philip, your views on?
Well, it would follow from, I think, mine and Brian's disagreement over the capacity of central banks to do these things. I don't really think central banks can actually do that much in the economy. They can at the extreme. I mean, if the central bank tomorrow in Britain raised interest rates to 15% or 20%, it will create a recession. I have absolutely no doubt about that. But beyond that, I don't think they can really fine tune policy or anything. I think central banks, there's been mission creep in central banks, and I share Brian's concern with that. I don't think it's productive. When they're engaged in these green lending programs and so on, they are quite literally allocating capital in the economy. They're giving preferential interest rates to certain sectors and saying that these sectors are basically important, and they've judged them important, so they should get done. I think I'm really suspicious of that. I think that's really, really bad. And unlike a government, which can do that, governments do that all the time, fine, but they have democratic accountability, at least in theory. Central banks don't. And so the way that they're moving into all these different directions is it's actually dangerous to democracy, in my opinion. But the capacity of the central bank, I just don't think is very great. I think that central banks are basically in the game now of holding the financial market hand, and that what they do is effectively become a kind of a rallying point for investment managers to watch. And when I was in financial markets, I was kind of repulsed by the whole thing because I thought the job of financial markets was to allocate capital, was to look at equities and try and see if this company was going to be a good company, and if it was, you'd allocate capital to it, or you'd take somebody's pension funds and you'd put them into a bond, which you think about on some sort of long term basis. That's not what financial markets have been doing, especially since 2008. They've just been central bank watching. Bank watching is now the game in financial markets, and so I think the whole system, the central banks have sort of corrupted the financial markets. I know I almost sound like an Austrian there, and I'm not actually an Austrian, but on this one, I do actually agree with the Austrians. I think that's basically what central banks have done. But even if you don't share that view, I suppose maybe it's controversial, but even if you don't share that view, I just don't think central banks are good at this. The central banks completely missed the beginning of the post pandemic inflation. I wrote a piece for Money Week just after the pandemic, and I didn't come at it from a monetarist point of view. I came at it from a very standard Keynesian point of view. Aggregate supply had declined because people had been shut away in their houses and they weren't able to work, and aggregate demand had been increased because government spending had risen. And I said, of course, this will create inflation. This is a very standard model. And central bankers said, no, it won't. And then it took them until inflation was very high until they admitted it. So even if they have control over inflation, if we look at their track record, it's abysmal. So I don't think central banks should be engaged in any of this. I think they should probably just park the interest rate at a certain real rate and just leave it alone and engage in bank supervision.
Well, that seems to me quite interesting that both of you are placing yourselves
Can I just comment on that?
Yeah, please do. Yeah.
Can I just comment on it? I mean, I think the record of central banks over the last, I don't know, so many years has not been great. But there was a time when, in the past, when from 78 to 2008 and so on, central banks did reasonably well. But I agree with Philip that they have messed things, or they mess things up. But if you say why it is, if you believe that money is not the cause of the price level, then I think, Philip, you have to explain what you think is the cause of the price level. And what worries me at present is that if you look at the models that central banks use, the basic input into determining the price level is the expectations of the price level based on previous expectations of the price level. And they are then saying, well, we as central bankers can influence the expectations of all players in the market, whether financial markets or commodity markets or markets for goods and services. So I think I have great difficulty in believing that the central banks can really influence expectations in the way they think they can. It's very interesting. If you look at productivity in the Western world since the great financial crisis of 2008, there really has been a change in the slope of growth of productivity. And if you look at various countries, the US has done remarkably well relatively on productivity growth. The UK is probably, of all advanced countries, G7 say, has done the worst. And with us, one of the factors which is key is that productivity growth in the public sector has been zero or negative. So as you've had a growing public sector, it's really been a drag on productivity growth. There are lots of ways people are trying to change the productivity growth, whether AI is something which is held out as a great hope, innovation in other areas, training of certain kinds, and so on. But certainly, I think the most interesting thing is, why is it that since the great financial crisis, everywhere in the world, the rate of growth of productivity has slowed down?
Philip, anything you want to say on that point?
Yeah, I've just done some work on the productivity question in a few articles that I've published recently. I think it's probably quite controversial to make this claim, but I kind of have come to a conclusion. I'm not really convinced by the productivity measures themselves. The way that the productivity is measured is by taking real GDP, that is inflation adjusted GDP, and dividing it by the labor force. Okay, so as Brian said, on that measurement, the United States has been growing its productivity better than, for example, Britain or many European countries. But of course, John, I think you also lived in America. I don't know if Brian did, but I'm sure you had the experience of paying for your healthcare insurance and realizing that it was just an enormous amount of people doing transactions with each other, and you're not actually, a lot of the money doesn't actually go into the health. Something similar could be said for the university system. The fees in the United States are absolutely enormous. Now, the interesting thing is that as the edu health sector grows, that's what it's classified as in the productivity statistics, that adds to GDP. And because I think the price adjustment isn't quite done properly, that adds to real GDP growth. And you can see this if you strip down the data and you look at it. This is telling you that productivity is growing in the United States. Now, productivity intuitively should mean output per worker or something like that. So you have a machine, you're making 2 widgets an hour, and then you bring in a new machine and you're making 4 widgets an hour. But that's not really what you're capturing in this productivity statistic. I do think that there is a serious problem with productivity falling, and I think it probably has to do with deindustrialization in Western economies. Service sectors just intuitively do not have productivity growth. There's an old saying among economists that if you get a haircut in 1850 and you get a haircut today, it's pretty much the same process. The scissors might be a little cheaper and a little sharper, but for the most part, it's one in, one out on haircuts, and it's probably that forever, really. That might not change. Maybe we'll get haircutting robots at some point, but they probably won't even be able to do it that much faster. So the service sector just seems to me inherently limited in its capacity for productivity growth, as opposed to manufacturing, which can have obvious return to scales. If you go and look at what's happening with Chinese EVs, you see that in action. Return to scale is very real in manufacturing. But so I do think that there's a productivity crisis. I'm very suspicious of the productivity figures, and especially the relative measures of that, together with PPP adjusted GDP, by the way. It affects that problem too. And in terms of government targeting it, I don't think that there's any way for governments to even remotely get a grasp on that. They're probably not targeting the right figure, first of all, but even if they were, I just don't see how a government could increase returns to scale in manufacturing or even add labor saving devices in the service sector. It makes no sense to me.
Mrs. Thatcher's government managed that, though, didn't it?
Productivity increases. I don't think there were very substantial productivity increases. Even if you take the standard measure, I mean, the 80s and the 90s were the period of what was called the productivity puzzle by I can't remember, it was an Italian economist or something who came up with it. But the popular statement of that by Robert Solov was, you can see productivity, you can see the internet revolution everywhere but in the GDP statistics. It was this mystery among economists that we had all these labor saving devices come into offices and productivity fell.
I'm thinking of the.
Can I just say, John? Can I just say,
please.
I think that Philip is absolutely correct. And the point he makes about the methodology of productivity, how we measure it and so on, is absolutely correct. And I agree with everything he said. When it comes to Mrs. Thatcher's period, when you and I were there, I think the one area where you saw productivity in a major way, and it was like a special light show or something like that was on privatization. I think on privatization, the data suggests something like that the employment of labor was something like 30% higher before productivity. So, the increase in productivity through privatization was really very considerable. But I'm not sure in other areas. I suppose you could say with Big Bang, because productivity in the service sector, in terms of Philip's example of haircuts, is absolutely valid. I think you could say that in the City of London, as a result of Big Bang, because of the influx of American firms and American banks in particular, we did see an increase in productivity. But I think what I'm talking about are two isolated things under Mrs. Thatcher.
Let me go back for a moment to the question of the impact of inflation on society. I'm thinking of some countries, Latin America, particularly Argentina, for example, in which inflation has become, for a very long time now, embedded. And it's very hard for governments to break out of that, or for the societies to break out of that. What are the effects of that embedded inflation, and is it ever possible to break out of that? And particularly, is President Milei succeeding in doing so? Because if he is, isn't that a big story? I'd go to you on that one, Brian.
Well, can I say I know very little, John, about Argentina and about Milei. I mean, I do know that in the past, that Chile, when it had some monetarists who went there and so on, and among others, Alan Walters, who we both knew, that had an effect. But I really can't comment on that. Except to say that if inflation takes hold in a country and becomes really embedded in everything, I'm not sure exactly what the real cost of inflation in Argentina has been if everyone expects there to be inflation and it's been possible to adjust various prices in line with your expectation. Because I mean, in looking at the cost of inflation, there is a fundamental difference between anticipated inflation and unanticipated inflation. And to the extent that in Argentina, unanticipated inflation over decades became virtually, whether it's fully adjusted, I'm not sure, but significantly adjusted, it would be very difficult then to go back and change it to price stability.
I was thinking of the social impact, though, because Argentina is, for example, a very low trust society. And the first people to tell you that are the Argentinians when you talk to them. One Argentinian woman, she was actually from abroad, but she settled there. She said to me, what we have in Argentina is a state of stable instability, which is, in a way, what you're describing when you talk about anticipated inflation. But it does have very bad effects on the society, I think, in terms of radical distrust, economic inefficiencies, and so on, to the which I think, and again, Philip's view on this would be interesting, which I think has produced a populace which is now, in a way, so fed up with the impact of inflation on society and its accompanying social effects that they have turned to Milei in some numbers. We'll find out in October's election, but because they are so fed up with the sheer difficulty of living in a society in which inflation is rampant and requires you to do all kinds of things which you or I don't have to worry about. And when a few years ago, when you visited, anyone visiting Argentina, there were, the money changing was technically illegal, but universal, activity. But any comment on Malay from Philip?
Well, yeah, I mean, the Malay phenomenon is kind of a consistent theme in Argentinian politics, that the inflation that's been there since basically the 1970s um, rears its ugly head, gets a little bad. They stop voting for a Peronist, they vote a Conservative in, the Conservative tries to control the inflation, typically fails, and then they vote a Peronist in again. The most successful period here to getting rid of the inflation was in the 90s with a currency board, but that led to an extremely bad recession after which the Paranists were voted back in. Then they had another attempt at this when I was working in finance. I actually worked on one of the Argentinian deals with Macri, and they tried a kind of Milei light policy, and it didn't work again. Paranus gets back in, inflation gets bad. Now they've put Malay in, and Malay's coming up against the same problems. The fundamental problem in Argentina, to my mind, is that they have the inflation's embedded in the system, and they have a constant exchange rate crisis due to this. Because if you have 30, 40, 50, 60% inflation every year, your currency has to adjust to maintain just basic competitiveness. But if you let it adjust, it feeds back into the inflation. It's sort of a doom loop. And I think the Malay government's now stuck there. They are currently once again controlling the exchange rate, which Malay said he wouldn't do. And they're actually doing it with loans from the IMF now. They've taken a very large loan from the IMF to try and prop up the peso. Again, Malay said he was not going to do that. So he's stuck back to where the Peronists were and Macri was before him, and so on and so forth. I think it's very, very difficult to get inflation like they have in Argentina disembedded from the economy. Because as you said, when you go, I've never been there, but everyone tells me this. If you go there, you just see that the society just takes inflation for granted, and so it just goes on and on. It seems to me, I'm pretty skeptical that Malay will be able to get the inflation under control, but I suppose we'll see.
Well, I think the inflation is so embedded that it is an extraordinarily difficult task. So the odds have to be against him. Having said which, he seems to be doing it much more effectively than anyone before him. And I've been looking at. Interest. We bought property in Argentina, and so we have an interest in it. But certainly since the Falklands War, the politics have yo-yoed of disinflation, have yo-yoed as you describe. Perhaps we should move on though, because I think there are other aspects of this. I wonder whether or not the social cause of inflation and the cultural cause of it, so to speak, we might discuss it in a way. Let me ask Brian about this. 50 years ago, the sociologist Daniel Bell argued that capitalism, because of its hedonistic appeal to consumers, tended to corrupt the Puritan values that made capitalism successful. Now, I don't think that Bell's argument has been fully confirmed. But if you look at the public sector, if you look at regulatory agencies, and that led, for example, the policies that led to the secondary banking scandal in the United States, the desire to ensure that everybody should, so to speak, get a piece of the housing market action, that did lead, did it not, to the collapse of the system. The near collapse of the system, the crash, and so on, and I wonder whether or not what do you now think about Bell's prediction about hedonism consuming capitalism's prospects? Not in the private sector, but more in the public sector, where the politicians appeal and intervene in ways that make inflation not essential, so to speak, but easier. No?
Do you want me to kick off, John?
Yes, would you? I'm about the cultural capture. Sorry, the cultural the cultural pressures that lead governments to behave in an inflationary way.
I think, John, that one thing that interested me in inflation is to take a longer look and go back in history. The price level in 1913 in the UK was roughly the price level in the mid-1820s. It went up and down, and there were particularly cycles associated with climate, the weather and so on, and agriculture, but there was no sort of constant inflation. But after 1937 in the UK, the price level has increased every year except one. So, and I think that has had, the public hate inflation. They feel it's deceit. There's a loss of trust. They get very angry, very suspicious because of it. In my book, I quote from Margaret Drabble in a great novel she wrote, part of which is about this. That leads to discontent, it leads to conflict, it leads to strikes and so on, a lack of confidence in the institutions, central banks, treasuries, and so on. So I think that culture there is very important in getting inflation a really very bad name. I think Daniel Bell's point is slightly different. And I would say with Daniel Bell that there was a revolution in the 1960s, which I feel I lived through when I was a student, and the 1970s, in terms of social morality. We saw we saw in terms of divorce law reform, abortion law reform, homosexual law reform, and a whole lot of things. You saw reforms and so on, which were held out as progressive and liberal. And then in the 1970s, 80s, we saw the heyday of Milton Friedman, Hayek, and so on, and we have liberalism. And I think the great financial crisis and the problems created by globalization, despite the benefits of globalization, have really led to people addressing liberalism and saying, well, can't we do better than this? And entering a sort of post-liberalism. And I think as people who believe in markets and the value of markets, it's really quite a challenge as to how we face this particular issue. And I once thought it was very simplistic. Well, I was very simplistic. I now think it's more difficult. So, for example, the whole debate that I'm coming across in London is a debate, in a way, between Locke and a more Judeo-Christian view of contract and covenant. And with contract being an act of consent, where with covenant being an act of assent. And particularly we talk about assent by people who are underage and so on. But even on the conservative side in Britain, led by, say, Danny Kruger, you do have, and he wrote a book entitled Covenant, you do have quite a strong view, which says we can do better than simply let the market rep and have maybe an anti-monopoly policy and so on. But we can do more than that. And I think I see it, I mean, at a personal level, the NHS, I grew up on the outskirts of Swansea, a town in Wales, where the local GP, every family knew him. He used to visit families whenever there was something wrong. Today, you can hardly get 10 minutes on the phone with the NHS. I mean, that's the norm. One is a contract, the other is much more a covenant. So I just feel a little humbled by the challenge. And I think the challenge comes really from Catholic theology. And I say that as a Protestant. Alistair MacIntyre, particularly a loss of virtue.
Well, I think this is a good introduction for you, Philip, because that's your book is about that, among other things, is it not?
Well, yeah, it is. I mean, I think generally speaking, I'm pretty much in favor of market allocation of capital and well, maybe not fully of capital, but definitely in terms of market-based exchange. The alternative controlled economies doesn't work. We know that. But I think what we've kind of underestimated is what you were talking about with Daniel Bell, that capitalism can actually undermine the foundations on which it rests. So I'll give two kind of the broad things that I'm interested in that sphere. The first is actually the kind of corruption of human relations. And I think that we underestimated that when capitalism has satiated basic consumer desires, so you might think of everyone has a fridge, everyone has a car, everyone has a reasonably okay house, although that's becoming very difficult for young people today. But when you've satiated those basic desires, and I'm thinking the kind of desires that were basically satiated probably by the 1980s in Britain for most people, if not for everybody, what do you turn to for your growth? I mean, what do you turn to for your per capita GDP growth at that point? You have to monetize other relationships. And I've called this in a recent article consumption deepening versus consumption widening. It's an analogy from capital deepening and capital widening in macroeconomics. And basically, what happens is once you've kind of run out of fridges to sell people and cars and things that are actually useful, indoor plumbing, that kind of thing, you tend to turn to try to monetize other social relationships. We're seeing this a lot with kind of apps on phones, dating apps, all this kind of thing. And some of the stuff that Brian's alluding to too, that you're focused when you're focused on a healthcare system. And by the way, it's not about public versus private. You'll see the same problems in America. You'll see the same problems in Ireland with a part private, part public healthcare system. It has this is to do with something else. It's to do with something to do with efficiency gains for their own sake or something like that. So I think it's very concerning to think that when you've satiated people's desires for useful things, that you might turn to start monetizing human relationships, which is definitely happening right now. The other concern is that I think there's very, very strong evidence that capitalism basically pushes people not to have families and low birth rates. And the reason for this is pretty obvious. The incentive structure of capitalism is to have as much production and consumption as possible. That drives as much profit as possible for the capitalist, and it drives as much GDP as possible for the government policymaker. Well, if you're engaged in production all day, if you're working all day, you don't have time to have a family. And this is what we've seen. But this is a paradox because if you don't have sufficiently large families and the TFR, the total fertility rate, falls below replacement rate, your society will age. And the effects of an aging society, which we see all over the West, are brutal. I mean, they destroy the pension system, they destroy the capacity to raise taxes, they produce a higher dependency ratio, which means that there's more elderly people for working people to take care of. That'll give rise to inflation over time. We haven't seen it yet, but it will. So there's a paradox there. So capitalism wants you to basically to go to work and not have a family, because if you're at work, you're making the GDP go up. But if you don't have a family, there's no replacement workers for you. So I think we're coming up against those kind of late stage liberal capitalist problems at the moment, and they're actually really profound, even from an economic point of view. They're certainly profound from a moral point of view, but they're actually profound from an economic point of view. But as Brian said, I think these debates have kind of started now, and I'm glad to see them.
Well, Brian, Philip, thank you very much indeed. We've gone quite a long way from a rise in the price level with which we began. Or have we? As Brian pointed out, one of the most successful periods of economic policy in which inflation was kept completely at bay was Victorian England. And Victorian England at that time was going through a period of religious and moral revival, the effects of which really lasted until the 1960s. So I am tempted to think that this has been a more productive and interesting discussion than it would have been if it had been kept to the strict bare bones of economic policy. And I'd like to thank you both very much indeed for taking part in it and provoking it and making it so interesting. Thank you.